Hello, everybody, and welcome back. Today, my guest is Lilian Co. Lilian is the CIO of LBN Advisers Limited, based in Hong Kong. And she's also the investment advisor to the strategic China Panda fund managed by EI Sturdza. Welcome, Lilian.
Hi.
Lilian, COP26 climate summit in Glasgow is nearly finished. So carbon neutrality is nevertheless getting closer. What do the decisions mean for the Chinese economy and the Chinese stock market?
I think China has already made it clear that it's going to reach carbon neutral by year 2030. So we expect a lot of the investments in clean energy space and reduced investments and reliance on coal-based electricity. I think this is not just a thing for China. I think it's actually a global trend.
So Chinese banks have recently delivered strong figures, but more than 40% of the bank's assets are directly or indirectly linked to the real estate sector. So, however, the Evergrande case has left many investors wondering how strong Chinese banks' balance sheets really are.
Actually, I'm not too worried about it. I mean, although the Chinese banks' property-related loan exposure is about 40%, but a large part of that goes to mortgage, and mortgage is a very safe loan asset with very low default rate. So the real loan exposure to the developers is probably the construction loans, and they are all pledged with land. And sales proceeds are used to repay the loan from the construction loan. So in my opinion, the loan assets are quite safe. So I think it's much safer than the credit lines to other industries that have no collateral.
Common prosperity has become the guiding theme of Chinese politics. What exactly does this mean? What are the consequences for the Chinese economy, and which companies are particularly affected?
Common prosperity, as the name suggests, I think is really about redistribution of wealth and income from the from the wealthy to the mass market. So I think what is likely to happen is increased tax in China. So what sort of tax are likely to be increased? I think probably consumption tax on luxury goods, property tax reform, and also optimization of individual income tax so that the high income group will pay more tax than the low income group. I think this is something that's already done by Western countries. So I think China is just catching up.
We've seen various regulatory measures in recent months, most notably against internet companies. Now the real estate sector and the energy crisis are preoccupying the financial markets. How much growth is this costing the Chinese economy?
Well, I would say it is indeed inserting pressure on the near-term growth in China. So you probably would, I don't really have a scientific calculation on that, but I think it probably would take away 1% GDP growth because of that. I mean, with all these regulatory issues, it definitely, I would say it definitely affects private investment. That's for sure, because of the uncertainty. But I think once the regulatory scrutiny is over, companies will have better visibility and the investment will return. So next year, I think next year we will have a better growth than this year.
The COVID-19 crisis has led to a high demand in a chip shortage. So at the same time, China is powerfully trying to expand its domestic semiconductor industry. How do you assess the development from a portfolio manager's perspective?
At the moment, I think the ones that benefit most is probably foreign companies like TSMC, because it's the foundry producer, and with this tight supply, TSMC is definitely in a better position. As for implication to investment opportunities in China, I would say you probably see more opportunities in I would say in TSMC, yes,
Yeah.
or foreign companies rather than domestic exposure.
So international investors have become more cautious about China and Chinese stocks after the euphoria of the last few years. Where do you currently find buying opportunities in China, and how do you generally position your portfolio in the current market phase?
I would say consumption remains a structural theme in China. Yes, this year is, I would say, a year of consolidation in China because of the regulatory reset. But once this is settled, like I mentioned earlier, investments will return. And we still firmly believe in the premiumization trend in China. So I think consumption will continue to be a major growth driver in Chinese economy. So we still like consumption play. And properties is now, I would say, this is the darkest moment for properties. If you look at the bond prices of many developers, they are pricing in bankruptcy already. And we think the policy direction from the government from this point onwards has to be more easing, because many companies are already seeing liquidity crunch. So as much as we are going through the darkest moment in Chinese property market, it is probably the time to look for opportunities in this space because of the distressed valuation.
So this was Lilian Co from LBN Advisers from Hong Kong. Thank you very much, Lilian, for being with us today and sharing your insights with us.
Thank you.